Today, we're going to be talking about tax buckets in retirement. What are they? Which ones should you have? Which are the best? In quotes. We're going to talk about that because, one of the biggest things I do as a retirement planner is plan for people's retirement income. But what happens also as part of all retirement and investing in life in general is taxes creep in. So we need to talk about taxes every once in a while. And my co-host Tony Shore was pushing for this show. So I'm going to bring him in a minute, but let me just bring in one of my kids. He has something he wants to say. It's really designed. He wants to say it to the regulators.
Dolphin Financial Group does not provide tax advice. See a CPA for tax advice.
Let me bring in my co-host, Tony Shore. Welcome to the show, Tony. We're going to talk about tax buckets in retirement.
Yay!
We did a show. Last show was on tax buckets of income buckets in retirement. And then you were complaining about how taxes weren't discussed. The show prior to that was tax brackets and filling up the tax bracket. And you were trying to tell me it should be filling up the tax buckets. So now you're getting your chance.
There we go.
Talk about tax buckets. What is your definition of tax buckets before we go? We'll call you General Q Public. Tax buckets.
So as I think that in retirement, I want some money that is in, you have your money that's in a tax bucket. In other words, money that when you take it out of wherever it's at, you have to pay tax on it. So that's your taxable bucket. And those are traditional 401ks and IRAs, which the majority of Americans have in retirement. Those are all tax deferred. So you have to pay full tax on everything you take out, the growth, the principal, everything. But so you don't get put up into a higher tax bracket or have too much of a tax burden in retirement, you should have also planned along the way to have a tax-free bucket of income. So taxable bucket of income in retirement, tax-free. And in the tax-free, I would say Roth IRA is the biggie, and we've talked about that. You've talked a lot about Roth IRAs. That's how I know about them. And you talk about, well, you haven't talked about this as much, but there's also cash value life insurance is another option for tax-free income in retirement or tax-free money, right?
Mm-hmm. Yeah. So you're on the same page. We're finally going to talk about this.
Okay, good.
I might use different terms, but your concept is, income is nice, but Uncle Sam is waiting. So
yes.
Do we pull from this bucket or that bucket, and how much do we pay in taxes? So I break it up into 3 different tax buckets in no preferential order. A, B, and C. So we'll start with A, tax bucket A, tax me now. Tax me now, darn it. These are also known as taxable buckets or after-tax buckets or non-qualified. You'll hear non-qualified a lot in my industry, and people glaze over with that. What does that mean? Qualified means the IRS is involved. Non-qualified means you've already paid taxes and they're not waiting. Now, here's the difference, though. Tax bucket A, tax now, means growth is taxed, typically as ordinary income or capital gains, depending on what it's invested in. It may not be even taxed at all. This could be a true tax-free bucket, Tony. What? Wait. I know it could get confusing because there are certain tools, instruments, financial products that can skirt and fall the line, cross the line, and go into different tax buckets. But for the most part, this is going to be something you get an annual 1099 for. Some examples of a taxable account, non-qualified account, would be just your bank account. This year, 2025, interest rates are pretty good. Last year in 2024, interest rates were finally decent, where you might actually get a 1099 from your bank for your savings account saying, hey, wow, you made interest more than $1, So you don't pay tax on what you put in. You pay tax on the gain. Investments outside of an IRA, you buy stocks or bonds, you might pay taxes on the gain if you realize the gain that year. A lot of people have joint accounts. That could be taxable, a taxable account. You and your spouse might invest in something or own a property, real estate, and When you go and sell it, you might have a gain, or you might have rental income from that. It's all taxable. CDs are a big one. A lot of people like CDs, especially in retirement. This is a retirement show. CDs, unless they're in an IRA, you're going to get a 1099 for them, whether you take the money or not. A lot of people are surprised by that. They say, I don't want the interest. I don't need the interest. I plan to give it to little Johnny. Well, you're still getting a 1099, whether you like it or not.
So are you saying you get a 1099 every year on a CD, even if it hasn't come to, what do they call that on a
Maturity?
CD? Maturity?
Yeah.
Wow.
So if you put 10,000 in a CD and you're getting 5% for a year, you're going to get a 1099 for $500. But you're like, I didn't take the money. It's worth 10,500. It's still sitting there. I'm going to roll it again. No, the way this works, because it's in a taxable account. It's in the Group A, Bucket A. You get 1099 for it. You can't defer those. You can't, if it was in a tax bucket B, a CD in the tax bucket B, then yeah. So
interesting.
The other point I want to make is there's a difference between ordinary income tax on this. Like for that CD, you got to pay whatever, like you had income, you got to pay ordinary income tax, whatever your tax bracket is. Remember that show? But if it's in a stock, say, and you sell it, you might not pay any tax on it, depending on, because it's the capital gains tax brackets, one of which is 0 or 15% or 20%. So there's a difference between capital gains and ordinary income tax brackets. So this is the one that most people have, but they don't realize. But you started the show saying IRAs, and that's the next tax bracket. Tax bucket is B. Tax bucket B is tax me later, please. See you later. This is tax deferred. Also,
so there's actually 3. Okay, tax now, tax later.
Right. And then
and my favorite bucket of all.
Don't
come on. Come on.
No. We're sticking on the deferred. So this is going to be qualified money. This is going to be growth, and the principal is taxed as ordinary income when you realize it. So when you take it out of the account, then you pay the tax on everything. There is an exception for non-qualified annuities. I'll get to that in a minute. But typical examples of bucket B, or tax me later, would be the traditional 401ks, traditional IRAs, 403bs, your thrift savings plan, TSP. These things are taxed me later. So
almost all employer-sponsored accounts like 403bs, 401ks,
right. There could be a Roth version. They could be a Roth version, but that's the third bucket. But this is the traditional IRA, traditional 401k. And what's happening there is you're putting money in and you're not paying tax on that money. That comes off your paycheck. I deposited $6,000 into my IRA in 2025. So I'm going to write that off on my income. So instead of making $10,000 of income, I've only made $4,000 because $6,000 was put into I didn't pay tax on that $6,000 that I put in the IRA until I take it out. Now, if that $6,000 turns to $60,000 by the time I pull it out, now I'm paying tax on the whole thing, all 60.
Yeah, so it's a risk, but the reason people set it up that way is the thinking, I think, was or can be, I'm employed full time. I'm in my highest earning years. Let's say I'm 50 years old. I'm in my highest earning years are 40, and I want to minimize my tax burden now, stay in a lower tax bracket, and pay taxes on that money later when I'm in retirement, when I don't have all this income. People think that way,
right?
But that's a fine line. You're walking a razor's edge there, because like you said, the old, do I want to pay tax on the seed now, or do I want to pay tax on the whole harvest later? It's great to keep your tax burden down now each year. So you're getting a tax break now, but later it's all going to come to fruition. And it's a ticking, as Ed Slott says, ticking tax time bomb.
It is. But I don't buy into it that this is the enemy. We'll get to that.
Right. It depends.
I'm going to ask you what your favorite bucket is, but
Okay.
before I do, let's finish out. I do want to bring up this idea of the annuities. Annuities by nature are tax deferred. So like a CD, you put 10,000 in the CD and you get 5%. You're paying 1099 interest on that CD, whether you like it or not, unless it's in an IRA.
Right.
An annuity doesn't have to be in an IRA to get tax deferral. It has tax deferral on growth in an annuity. So if you put 10,000 after tax, taxable, whatever you want to call it, non-qualified, into an annuity, and it grows, you don't get a 1099 that year unless you take the growth.
Mm-hmm.
The downside is when you do take growth of annuities, it's taxed as ordinary income, not capital gains.
Just like a 401k or an IRA.
Right, but only the growth is on the annuities.
Only the growth, so not the principal.
Right. Unless it's in an IRA, then the whole thing's taxed.
Yeah.
Okay. Let's switch over to bucket C. Tax bucket C is tax me never. See, this is what people say. Oh, it's tax me never. It's tax free. It's not tax free.
Because you pay taxes on it initially.
Well, not always. So growth and principal are tax free if you follow the rules.
Sure.
There's a whole bunch of rules on these, but let's go through some typical examples. So you got the Roth versions of the IRA, 401k, 403b, Roth TSP, thrift savings plan. So you have the Roth means you pay taxes, you don't write it off as you put it in. So you make that in your salary and you put it into a Roth IRA or Roth 401k. You're getting taxed on it. Like you said, you're getting taxed on it now, but you don't pay tax on it ever again. And that's the most common one. And a lot of people say, well, why wouldn't I just put everything in a Roth? Well, because you got to pay taxes on it now. Right. So there's a balance. You have to do some math. You have to think. You have to.
Right. Because everything you put into a Roth is that money shows up as income on your tax return. So, or you have to, when you do your taxes,
right.
You have to count any money that you got to put into the Roth as income. It hits your bottom line. It hits your earned income.
Right. And well, there's a lot of limits to the Roth, or you can't put the money in until if you make too much, right? There's a bracket. There's a tax income limit where you're not allowed to contribute to Roth. You can still do conversions though. So the theory was, well, if you make so much money that you can't put into Roth, that's exactly why you would want to put it into a traditional, because you're at the high tax bracket. So it makes sense to defer the taxes for later.
Right.
Because the theory is you'll be at a lower tax bracket in retirement. But then it's like, well, if I can contribute to a Roth, that means my income's low enough. Well, why would I want to contribute to the Roth? Because my taxes are low right now. I don't know what they'll be. So again, that's the most traditional ones. I shouldn't say that's the most common ones is the Roth. You got municipal bonds. Now, how does that work? That's the interest, not the capital gains. You sell a mutual fund, a municipal bond for a gain, you're paying capital gains tax. But the interest is not taxed by the federal government. And it might not be taxed by your state government, depending on where the municipality is. 529s are another example. You put after-tax money in, but as long as you use it, follow the rules for education purposes, then you don't pay tax on the gains. But here's the biggie, Tony. Health savings accounts.
Yeah. That's the best one yet, because
that's truly the tax me never.
Yeah.
Because you don't pay tax on what you put into an HSA, health savings account, and you don't pay tax when you take that out, and you don't pay tax on the gains. So that is the true tax me never account.
Although you have to have enough money to cover the high deductible costs.
Yeah, so there is a downside to it. HSA isn't the be all end all, but if I had to choose one, that would be
right.
It's
the only tax designation in the IRS code that is completely tax free. You put money in, you don't have to pay taxes on that money ever. And if you use it right, you don't ever have to pay taxes, right? It's the only account that goes in tax-free, grows tax-free, comes out tax-free.
Right. Correct. Because you can make the case that life insurance is tax-free, but on your death. right? Unless
Right.
you borrow from it, someone's going to pay taxes.
But
Unless
you
you
pay
die.
taxes on the money you put into it.
Right. Right. You don't
So
get the
that's
tax
not
write-off when
completely.
you put it in. You
Mhm.
get a tax write-off on the health savings account. The problem with the health savings account, like you said, is you have to have a high deductible health plan. So
Mhm.
you may not even have access to one, or you might not want it. It might be, you might have health needs, and it's like the other plan makes more sense financially. I
Yeah.
know I can add to an HSA, but I don't want to because I have huge medical expenses. I don't want that high deductible. But all right, so those are the three buckets, right? I just told you what my favorite is. What is your favorite, Tony? And
I
there's
know. I noticed you avoided cash value life insurance. Talking about that
that's an example of
tax-free bucket or
that's like
tax.
right, but I do bring that up. So here's some considerations before I put you on the spot, because I know you're just gonna say health savings account because that's the right answer. But which one's best? Well, all right, Tony, which one do you think is best of the three buckets? The tax me now, tax me later, or tax me never?
My initial gut instinct is to say tax me never, but it depends on what it depends on, are you upper class wealthy, are you middle class, or are you paycheck to paycheck? I don't
Well,
think if you're paycheck to paycheck, the Roth I don't think makes sense. If you're middle class, though, I think there are a lot of middle class families with a lot of kids and a lot of health expenses that I would argue HSAs not for them. At one point, my wife and I did the math. We looked hard at it. We talked to some experts, and it was not cost effective for us. And we wouldn't have been able to put money in it and just leave it there at that point because we needed the money for medical expenses, and the high deductible account that it came with didn't give us enough coverage. And just the co-pays, paying, I would have had to pay 100% every time one of my kids or myself went to the doctor, rather than a 25 at that
right.
point $25 copay.
Yeah, well,
So I'm like,
now we're harkening back to the good old days.
yeah, I know, but I would say the tax-free bucket for myself, and the situation my family is in. But I think they all have. I think it's a balance. We want regular traditional 401ks. We need to have money coming off of our taxes at this point.
Well,
now,
yes, now. So if I said let's fast forward, and now you're 65 and you're retired, right? You and your wife are both retired. Which bucket would you want to have?
I would say the Roth bucket, tax-free bucket.
Tax-free bucket, right?
Yeah.
But you can't do it that way because how did you get there? If you have 100% in a Roth, how did that happen?
Right.
You pay taxes now leading up. So this is a retirement show, but it's also planning your retirement, and which is very useful for people to say, let's just do the Roth. I want to have all tax-free income when I'm in my 70s. Do you? Because that means you pay tax in your 50s and 40s and 60s, right?
On everything. Yeah.
You have to think, how do you get there? Right?
Mhm.
You have to think about that.
Yeah, and right now, my wife and I put more into the. I'm talking out of both sides of my mouth, because if you look at what we're doing right now, we're putting more in the traditional 401k and IRA than we are in a Roth.
But that's the first consideration, is tax brackets. What's your tax bracket now?
Yes.
What do you think it's going to be in the future? If you think your tax bracket's going to be extremely higher in the future, yeah, then you do the Roth now. But if you think that your tax bracket might be lower or the same in the future, then maybe the Roth doesn't make sense. Maybe the traditional makes sense. For most people, they peak earning years are in their 50s.
Yeah.
So maybe that's the time you do traditional, and then you put in the Roth. It's not. You're right. You said it right. You said you need a balance, but the tax bracket's the number one consideration. So it's different for every person, every situation.
It is.
We just did a show on retirement income. That's the other consideration. Where am I going to pull my retirement from? A lot of people might not have a pension anymore, but Social Security might be a big piece of it. So they may not need to pull so much income from their savings, and they can play around with it. If you're building a retirement income plan, you want to figure out the tax buckets while you're building it, so you're not stuck. A lot of people are retired and they're stuck with 100% in tax deferred bucket B. They don't have a choice. They put it all in the 401k.
Yep.
And
I would
now
say
they're
that's
stuck.
the majority of
Right.
people, right? That you
Right.
meet with. Yeah.
And then, so what are you going to do? There's limits to what you can do, but you could make some changes before you retire or early retirement.
Sure.
The other factor, required minimum distributions, right? So back to that scenario where all your money's in the IRA, 401k, you're going to be forced to take money out of that, where you're not forced to take money out of the other two buckets. So you're forced to take money out of your IRA 401k, but you're
Yeah.
not forced to take money out of your taxable account at
And
the
no
bank.
RMDs.
No
So
RMDs.
if you've got a chunk of money that you want to pass along, maybe you want some in the Roth. But you said something that I think is dangerous. A second ago, a minute ago, you said, if you think your income is going to be lower in retirement, maybe you don't want to do the Roth or the tax-free option. Here's the problem with that. A lot of people, the majority of people, think that they're not going to, they think in my working years, I'm paying way more taxes than I'm going to in retirement. People assume what you said, and that is not always correct.
Not
a lot
always
of
correct.
people, yeah.
You
So
don't
you
know
got to
what
be
the tax
wary.
bracket will
Some
be.
of our listeners out there might think, well, of course I'm going to pay less taxes in retirement. They might be right, but for
Right.
some of them, they're wrong, right?
You have to think, you don't know what the
Yeah.
tax brackets are going to be. You have to make some guesses, but you have to think about it. You can't just bury your head in the sand and put it all into the Roth or all into the
That's
tradition.
why people need to work with somebody like yourself, a financial services professional, who's a trusted fiduciary, is going to look out for your best interests in all cases and look at the big picture. You know, they've got a big puzzle in front of them with 1,000 pieces not put together. You're looking at the box lid, and that's
this
the
is
most
tax
important
planning.
thing.
This isn't doing your taxes every year. This is tax
No.
planning. This is
Yeah.
taking a big picture and saying, all right, in 10 years, what might your tax situation be? If
Yeah.
you continue down this path, it's going to look like this path, your buckets. So it's coming up with a balance in the future. And what do I do now?
Right.
Some other considerations would be the qualified charitable distributions, QCDs. We did a show on that. That's a way to take money out of a tax me later deferred bucket and put it in the tax me never. It's a way. You're giving charity away, but you're not paying taxes on it. But you're reducing your RMD or you're satisfying it by not paying taxes. Legacy desires, that's a big one. There's where life insurance would come in. Do you want to leave a legacy? If that's important, then do you want to leave a legacy where they are stuck with taxes, or do you want to pay the taxes? Because, all right, traditionally you die, let's say early 80s. Well, that's the new 60s from, when a couple generations ago. So your children theoretically would be in their 50s, 60s when you die. If you leave them an IRA and they have to take it out now in the new rules within 10 years, they might be forced to take that taxable account, pay taxes on it during their peak earning years. So if that's an issue, then you might change your buckets based on the legacy. The other ones that we've done in the past show on health insurance subsidies, both the Affordable Care Act subsidies and also medical IRMA, the tax penalty if your income's so much. So that's another consideration with your tax buckets is, well, is this going to bump me to a point where I'm going to pay more for health insurance because of the way my tax buckets are set up?
Yeah.
So again, most people believe that the tax-free bucket is the best bucket, but in reality, it may not be the best bucket. It's going to depend on your situation. I think the HSA is the best bucket, but maybe you can't even get an HSA, or maybe, like Tony said, an HSA doesn't make financial sense for you in that moment. But did you ever think about it? Did you talk about it? Have you been thinking about, well, I get the idea that Dan did last week of you need retirement income to cover different years of my life and different risk levels. But did you think about the different taxation levels? You might be forcing yourself into a higher tax bracket in retirement without even knowing it. But you could change that now by making some changes to how you're investing, how you're saving, and which bucket you're putting your savings in. So
you have to ask the question,
what is your tax plan?
what is your tax plan? And most people do not have a tax plan.
Right.
A lot of people have retirement
A
plans. More and
long-term
more
tax plan. Yeah.
Right. More and more people have retirement plans, but tax planning should be a key component of retirement planning. That's why it's extremely important to do tax planning. And I would conclude by saying the answer is what Tony said. You're right. You need a balance. The balance of having money in all three buckets when you retire is it gives you the flexibility and to be nimble and take advantage of different tax savings opportunities. You know, from 60 to 65, if you're retired, you want to have some non-taxable money options to reduce your healthcare costs by getting a higher healthcare subsidy. When you're 65 to 70, you might want to start increasing your tax-free bucket so that your RMDs go down at 73. Or you might be up against that tax bracket or the IRMA level and say, geez, I don't want to show the income, but now I have the RMD. I wish I would have done some maneuvering earlier because now I'm paying the price. So there's something to be said about having multiple options and allowing yourself to be much more nimble.
A balance between the three buckets is what you're saying. Yeah.
Right. So if someone says, I got 100% of my money in the Roth, you might think, oh my God, what a genius. But are they?
Yeah.
They paid taxes when? And think of all the money they gave to Uncle Sam to convert that or to put that money in.
Yeah.
Now, on a side note, my oldest child has been working for a few years. He started working, I think, at 15. And so now he's got like 4 years of work history. I've been putting money into his Roth that he gets as gifts. Instead of just giving it to him in cash, I've been putting into his Roth. And he doesn't even know it, right? So when he's 60, hopefully I'm around, and he says, he's going to say, Dad, thank you for this. And maybe this show will be on YouTube. And I could say, remember that, my son.
That's awesome. Yeah, my daughter's 21 and she has a Roth. She started one.
Right. So talk about potential growth opportunity tax-free.
Talk about massive potential for growth.
Right.
It's the little acorn that becomes the mighty oak.
Yes.
Little Bill Murray line from Stripes.
All right. There you go. All right, Tony. So we did it. Are you satisfied now? We talked about your tax buckets.
Yeah.
All right. And which one's your favorite?
Probably tax-free still, but a balance. A balance.
We all get it. Thanks for a good show. We'll catch everyone next week.
All matters discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Riddle nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management, Inc. and Dolphin Insurance, Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.